When I look at a market day like this, I do not begin with excitement. I begin with cause and effect. I begin by asking a simple question: what is actually happening beneath the price movements? A stock goes up 4%, another stock falls 15%, another falls 13%. A few large companies report earnings within the same hour. Headlines come out, people react, prices move, emotions get loud. But the real investor does not start with the noise. The real investor starts with the machine. Today was one of those days when the market showed you several machines working at the same time. AMD continued to show strength. It was not a small move. It was another sign that capital is still flowing into the companies that provide the picks and shovels of the AI build-out. At the same time, several high-growth names were punished hard. SoFi fell sharply, Robinhood fell sharply, Coinbase weakened, HIMS fell, MicroStrategy pulled back. If you only watch prices, you will think the market is confused. If you understand the structure, you will see something much clearer. The market is trying to separate companies that are spending money from companies that are receiving that money. That is the whole story right now. Meta, Amazon, Google, and Microsoft all reported earnings. Cheesecake Factory also reported. And inside all of those numbers, there was a lesson about capital allocation, operating leverage, AI spending, and the difference between a business that is compounding and a business that is creating uncertainty. Then there is another company, SoFi, that the market punished in the short term, even though the underlying numbers told a very different story. That is why this kind of day matters. Not because one stock moved up or down after hours, not because one headline sounded good or bad. It matters because earnings season is when stories are forced to meet reality. I have spent my life studying systems, economic systems, debt systems, business systems, human behavior, market cycles. The principle is always the same. You do not judge a system by what it says. You judge it by what it produces. So when a company reports earnings, I ask a few simple questions. Is revenue growing? Are expenses growing faster or slower than revenue? Is operating income growing faster than revenue? Is the business gaining leverage as it scales, or is it being forced to spend more and more just to maintain the same growth? Is management using capital in a way that creates durable future earnings, or is management creating a hole that will have to be filled later? That is the lens through which I want you to look at these companies. Let us start with Meta. Meta reported what I would call a B-grade income statement. That does not mean the business is weak. It does not mean the company is broken. It means the numbers were good in some places. But the quality of those numbers was not as strong as the headline might suggest. Revenue grew 33%. That is a very strong number for a company of Meta's size. Among the biggest technology companies, that kind of revenue growth is impressive. It tells you the core advertising machine is still powerful. It tells you the platforms still have reach. It tells you the business is still capable of pulling enormous amounts of money through its system. But then you have to look underneath that number. Cost of revenue grew 35%. Research and development grew 46%. Total costs and expenses grew 35%. That means the cost base grew faster than revenue. That is not what you want to see in a great operating model. A great business does not merely grow, it scales. A great business should produce more income for every additional dollar of revenue because the fixed cost structure becomes more efficient over time. If revenue grows 33% and operating income grows 40% or 50%, that is a sign of leverage. But Meta's income from operations grew 30%, which is lower than revenue growth. Income before taxes grew only 18%. Then the company received a very large one-time tax benefit, more than $5 billion, which made net income and diluted earnings per share look much better than they otherwise would have looked. Net income looked strong. Earnings per share looked very strong. But the quality of that strength requires caution. A serious investor has to separate recurring operating performance from one-time help. If a number improves because the core machine improved, that matters. If a number improves because of a tax benefit, that is different. You do not ignore it, but you do not build a long-term thesis on it. That is why I do not call this an A-grade report. The revenue was excellent, the spending was the problem, and the spending problem is not small. Meta now expects capital expenditures of roughly $125 to $145 billion for the year. That is an extraordinary number. It was already high, then it moved higher. And when a company of Meta's size keeps raising the spending bar, you have to ask the hardest question in investing. Why? Not emotionally, not with anger, with clarity. Why does the business need to spend that much money if the answer is clear? The market can accept it. If the answer is unclear, the market punishes uncertainty. With Amazon, the answer is clearer. With Google, the answer is clearer. With Meta, the answer is more difficult. Yes, Meta is investing in AI. Yes, Meta needs infrastructure. Yes, Meta has to remain competitive in a world where AI changes advertising, content, communication, and the way people interact with digital products. But the scale of the spend is now so large that investors need to see the causal link. They need to see how that spending turns into revenue, margin, and durable free cash flow. If the company spends more because it allows revenue to grow a little faster, maybe that makes sense. But if the company must spend enormous sums just to keep the platform relevant, that is a very different situation. And this is where Meta creates risk. The company also reported daily active people of about 3.56 billion. That was up 4% from the prior year, but it was down from the most recent quarter and below what Wall Street expected. Meta pointed to factors like the Iran war and WhatsApp access restrictions in Russia. Those explanations may be valid. But as an investor, the principle is simple. You never want to see usage go backward at a platform company. A platform's strength comes from network effects. More users create more value, more engagement creates more data creates better advertising. Better advertising creates more revenue. That flywheel matters. When the user number weakens even temporarily, you watch it closely. I am not saying Meta is finished. That would be foolish. Mark Zuckerberg has gone through these cycles before. He has spent heavily before, he has been criticized before, he has looked reckless before, and in the long run he has often come through. But the path between now and that long-run outcome can be ugly. This is a principle that most investors do not understand. A great business can still be a painful stock for a long period of time if the market loses confidence in management. Capital discipline. Meta has been through that before. In 2022, the stock was punished heavily because investors believed spending had gotten out of control. Eventually, the pressure forced discipline. Expenses were reduced. The stock recovered. The machine improved. That could happen again. But if spending keeps rising and the company cannot explain clearly why the next $100 billion of capital creates attractive returns, then the market may demand discipline the only way markets know how to demand it. Through the stock price. That does not mean I would bet against Meta. I would not think about it that way. It means I would understand the risk. Meta can still be a powerful long-term business, but the next phase may be messy because the spend is becoming the central issue. Now compare that with Amazon. Amazon reported what I would call an A-grade income statement. The difference is visible in the structure. Total net sales grew 17%, cost of sales grew 14%, fulfillment grew 11%, sales and marketing grew only 6%. General and administrative expense actually declined 2%. Total operating expenses grew 15% while net sales grew 17%. That means the business showed operating leverage. Operating income grew 30%. That is what you want to see. Revenue grows, but the income grows faster. That tells you the machine is scaling. There was also a one-time item that helped some of the numbers, so you do not want to pretend everything was pure operating improvement. But the basic structure of the report was strong. Then you look at AWS, that is the most important line item for Amazon. AWS revenue came in at about $37.59 billion ahead of expectations and grew 28% year over year. That marked its fastest growth in more than 3 years. That matters. Amazon is spending aggressively, just like every major technology company is spending aggressively. But with Amazon, investors can look at AWS and see a direct reason for the spending. Customers need cloud capacity, AI workloads require infrastructure, enterprise demand is rising, AWS is accelerating. When a company spends heavily and the business directly connected to that spending is accelerating, the market can understand the logic. It is the difference between spending that feels vague and spending that feels connected to a proven revenue engine. Amazon's advertising business also keeps becoming more important. Advertising revenue grew 24% to more than $17 billion. That business has become a third giant inside Amazon alongside e-commerce and AWS. It is high margin, it is growing fast, it is deeply connected to Amazon's commerce ecosystem. That is why Amazon's story is different from Meta's story. Amazon is also spending heavily. But Amazon has two powerful engines that make the spend easier to defend. AWS is accelerating, advertising is growing. The company has operating leverage. So when Amazon talks about massive investment, the investor can say, I can see where the money is going. I can see where the return may come from. I can see the causal chain. That is how I think about Amazon. It is one of those rare companies that has looked expensive many times in its history, and yet the underlying machine kept compounding. Before the tech bubble collapsed, Amazon looked expensive. After the tech bubble, people doubted it. Before the financial crisis, it looked difficult. During the financial crisis, it looked dangerous. After the financial crisis, it kept building. During the pandemic, it looked overstretched. After the pandemic, people questioned the e-commerce side, and still, over time, the machine found new engines. That does not mean you buy blindly at any price. Price matters, expected return matters. But structurally, Amazon remains one of the strongest business systems in the world because it has multiple engines, scale advantages, and a culture that has historically been willing to invest for long-term dominance. Now look at Google. Google reported what I would call an A-plus income statement. Revenue grew 22%, cost of revenue grew only 14%. Total costs and expenses grew 18%, income from operations grew 30%. That is operating leverage. That is the kind of structure you want. Again, there was a very large one-time other income item, which made net income and earnings per share look even stronger. You have to normalize for that. But even without being overly impressed by the one, Time boost, the core operating performance was very strong. The most important part was Google Cloud. Google Cloud revenue came in above $20 billion for the quarter, well above expectations. It grew roughly 63% year over year. That is extraordinary for a business already doing more than $20 billion in quarterly revenue. This is why the market can accept Google increasing capital expenditures. When Google raises capex to something like $190 billion, the number sounds shocking. But then investors look at Google Cloud and see a business growing more than 60%. The spend is tied to a visible growth engine. This is why Google is being treated differently from Meta. Both are increasing spending, but Google has a specific cloud business that is exploding. Amazon has AWS, Microsoft has Azure, although the story there is more mixed. Meta has a broader AI story, but it is harder for the investor to isolate the direct return. That distinction matters. Capital expenditure is not automatically bad. CapEx is only bad when the return on that CapEx is unclear or poor. If a company spends $100 billion and creates $300 billion of durable future value, that spending was wise. If it spends $100 billion and merely protects a business that would otherwise decline, the return may be much weaker. The market is trying to judge which of these is happening. Google, at least for now, is making the argument easier. But that does not mean the stock is automatically the best opportunity at any price. There is a difference between a great business report and a great entry point. The best time to buy Google was when fear was higher and the valuation was lower. When a stock has already run significantly and the market begins to recognize the quality, the forward return becomes less attractive. That is another principle. Quality and price are separate variables. A company can be excellent and still not be the best buy today. A company can report a great quarter and still be closer to a hold than a buy if the valuation has already adjusted. Now let us look at Microsoft. Microsoft also reported what I would call an A-grade income statement. Revenue grew 18%. Total cost of revenue grew 22%, which is not ideal. But research and development grew only 9%. Sales and marketing grew 10%. General and administrative expense grew 11%. Those line items helped the overall operating structure. Operating income grew 20%, faster than revenue. Net income grew 23%. Diluted earnings per share grew 23%. This was not an A+ because cost of revenue grew faster than revenue, but the overall report was still strong. Microsoft is also spending heavily. The company is talking about roughly $190 billion in capital spending tied to AI infrastructure and memory pricing. That is a huge number. But the key issue for Microsoft is Azure. Azure is still growing strongly, roughly around the high 30s. But compared with AWS acceleration and Google Cloud acceleration, the market may be looking for more. AWS growth is accelerating. Google Cloud growth is exploding. Azure is strong, but it is not showing the same kind of upside surprise. That is why Microsoft's report is good, but the reaction can be more measured. The important structural point is this. All of these companies are spending enormous amounts of money. Meta, Amazon, Google, Microsoft, they are all building for AI. They are all buying infrastructure. They are all increasing capacity. They are all competing for computing power, memory, chips, data center equipment, cooling systems, and cloud scale. If you are trying to understand where the money is going, do not only look at the companies spending it, look at the companies receiving it. That is why a day like this makes me more confident in companies like Nvidia, AMD, and Micron over the next 12 to 18 months than in some of the mega cap companies that are doing the spending. The spenders may eventually win, but in the short term, the suppliers are getting paid. If Meta raises capex, Nvidia benefits. If Amazon increases cloud investment, Nvidia benefits, AMD benefits, Micron benefits. If Google spends more on AI infrastructure, the same suppliers benefit if Microsoft spends more because memory prices are soaring. That is a signal for memory suppliers. This is a classic pick and shovel pattern in a gold rush. The most reliable early winners are often not the miners. They are the companies selling the tools. That does not mean every chip company is equally attractive. It does not mean price does not matter. It does not mean there will be no volatility. But the direction of the money flow is clear. The large platforms are fighting for AI capacity, and that means capital is flowing to the semiconductor and memory ecosystem. This is why I would not be surprised to see AMD, Nvidia, and Micron continue to show strength as long as the big technology companies keep increasing capital spending. The risk to those suppliers comes when the big buyers begin to moderate spending. When the market hears that Meta is cutting back, Amazon is slowing down, Google is done building, Microsoft is reducing capex, then the supplier thesis changes, but that is not what these reports showed. These reports showed the opposite. The spend is still rising. The AI infrastructure cycle is still being funded. That is a very important signal. Now let us move away from the AI capex war and look at a completely different kind of business. Cheesecake Factory. I like looking at a company like this in the middle of an AI-heavy earnings season because it reminds you that investing is not only about the most exciting theme, sometimes a simpler business creates clearer economics. Cheesecake Factory reported what I would call a B+ Plus, income statement revenue grew to about $978 million from $927 million in the same quarter last year. Food and beverage costs fell as a percentage of revenue. Labor expense fell as a percentage of revenue. Those are good signs. Other operating costs and expenses were a little higher as a percentage of revenue, which kept the report from being better. General and administrative expense was stable as a percentage of revenue. Total costs and expenses were roughly in line as a percentage of revenue, but because revenue grew, income from operations improved. Operating income came in around $55 million versus just under $52 million in the same quarter last year. There was also a debt extinguishment loss last year that did not repeat this year, which helped net income comparisons. Net income moved to roughly $49.5 million versus $32.9 million last year. Diluted earnings per share moved to about $1.02 versus 67 cents. This is not the kind of business that creates viral market excitement, but that can be an advantage. Cheesecake Factory does not have to spend $100 billion on AI chips. It does not have to explain why CapEx is exploding. It does not need to win the cloud war. It needs to run good restaurants, manage food and labor costs, expand concepts like North Italia and Flower Child, continue operating the Cheesecake Factory brand, and return capital in a sensible way. That makes the business easier to understand. There is value in simplicity in markets. People often overpay for complexity because complexity feels exciting. But durable wealth is often built by owning understandable businesses that can compound steadily for many years. Cheesecake Factory has the flagship brand, it has expansion opportunities, it has dividends, it has a path for long-term value creation that is not dependent on speculative AI economics. That does not make it risk. Free restaurants are difficult. Labor costs matter, food costs matter, consumer spending matters, execution matters, but the business is tangible. People eat. Good concepts can expand. A company with disciplined operations and a reasonable valuation can produce attractive returns without needing to be the next technological revolution. That brings us to the company the market punished, even though the numbers were very strong. SoFi. This is the kind of situation that separates price reaction from business reality. The stock fell hard, but the income statement was excellent. I would call it an A-plus income statement. Total interest income grew 31% year over year. Total interest expense grew only 16%. Net interest income grew 39%. Loan origination, sales, securitizations, and servicing revenue grew 169%. Technology products and solutions was weak, down 43%. And that matters, you do not ignore the weak line item. Loan platform fees grew 49%. Other revenue grew 87%. Total non-interest income grew 49%. Total net revenue grew 43%. To about $1.1 billion, up from $771 million. Total non-interest expense grew around 30%. That means revenue growth outpaced expense growth. Income before income taxes grew about 150%. Net income grew 135%. Despite a much higher tax expense, diluted earnings per share doubled from 6 cents to 12 cents. That is a powerful report. The market may sell the stock in the short term, but as an investor, I do not ask whether people were emotional for one day. I ask whether the business is executing. SoFi's member count grew to 14.7 million from 10.9 million. That is a major increase long term. The company still has a lot of room to grow. A digital financial platform with a strong brand, expanding product set, and disciplined execution can potentially reach a much larger member base over time. The Galileo technology platform also matters. Platform accounts had been declining from about 160 million to 158 million and then to 128 million. In this report, they reversed direction and increased to about 133 million. That may not look like the biggest headline, but in systems, changes in direction matter. When a weak trend begins to stabilize or reverse, you pay attention. SoFi is not just a simple bank. It is trying to build a modern financial ecosystem, lending, deposits, investing, credit, technology, platform services, financial products. The bigger the member base becomes, the more cross-selling opportunities exist. The more products a customer uses, the more valuable that customer becomes. The more data the company has, the more efficient underwriting and product design can become. That is the potential flywheel. But I want to be clear about risk because risk must always be part of the conversation. SoFi operates in a banking and finance-related space. Banking businesses can carry tail risk. If a company takes too much balance sheet risk, if credit quality deteriorates, if funding becomes stressed, if management misjudges the cycle, things can go very wrong. Any financial company has a zero-risk scenario in the extreme case. That is why position sizing matters. You can believe in the upside and still respect the possibility of severe downside. That is how I think about it. The company can be very attractive long-term and still not be something you over-concentrate in. A good thesis does not remove the need for risk management. SoFi has the potential to become a much larger company over time. It could become a serious threat to traditional banks. Wells Fargo, Bank of America, JPM, and other large financial institutions should not dismiss a digital platform that keeps adding members and expanding products. It is also competing with fintech companies. It is moving into stocks. It is moving into crypto. It is broadening the financial relationship with customers that gives it long-term potential. But the right way to think about a company like this is not to ask whether it will go up tomorrow. The right question is whether the business can keep executing over 5 years, 10 years, and beyond. Can revenue keep growing? Can expenses remain controlled? Can the company scale profitably? Can it avoid reckless credit risk? Can it keep adding members at attractive economics? Can it become a trusted financial platform for a new generation? If the answer is yes, then short-term sell-offs can become opportunities. If the answer becomes no, then the thesis changes. This is why I never want to become religious about a stock. A stock is not an identity. It is a claim on future cash flows. When the facts change, the thesis must change. But when the facts improve and the price falls, that can create opportunity. That is what I see in the SoFi report. The stock was punished. The numbers were strong. The long-term opportunity remains real. The risk also remains real. That combination is exactly why investing requires principles. Without principles, you will chase what is up and abandon what is down. With principles, you can separate volatility from deterioration. Those are different things. Volatility means the price moved. Deterioration means the business got worse. Sometimes both happen together. Sometimes the price falls while the business improves. That is where opportunity lives. So when I look at this entire earnings day, here is the bigger lesson. Meta is still a powerful company, but spending is creating uncertainty. Amazon is spending aggressively, but AWS and advertising provide a clearer causal chain. Google is spending aggressively, but Google Cloud growth is so strong that the market can understand the reason. Microsoft is strong, but Azure needs to show the kind of acceleration that AWS and Google Cloud are showing if the market is going to reward the CapEx story in the same way. The chip and memory suppliers are receiving the money, which may make them the better near-term beneficiaries of the AI capital expenditure cycle. Cheesecake Factory reminds us that simple cash-producing businesses can still be very attractive in a market obsessed with AI. SoFi shows that a stock can collapse in the short term even when the business report is strong. That is the real lesson. Markets are not perfectly rational in the short term, but they are not random over the long term. Over time, earnings matter, margins matter, cash flow matters, capital allocation matters. Balance sheet risk matters, management discipline matters, a company can talk, a CEO can tell a story, a market can react emotionally. But eventually, the numbers reveal the truth. This is why I always come back to cause and effect. If expenses grow faster than revenue, pressure builds. If CapEx rises without a clear return, doubt builds. If revenue accelerates in the segment directly connected to the spending, confidence builds. If members grow, revenue grows, expenses stay controlled, and net income expands, the business is improving. If valuation already reflects the improvement, the return may be limited. If the market ignores the improvement, the opportunity may be larger. That is investing. It is not about finding one magical stock and turning your brain off. It is about continuously measuring reality against price. The market will give you noise every day. Some days the noise will be loud. Stocks will move up and down by 10, 15, 20%. People will become euphoric. People will panic. Analysts will change ratings. Headlines will exaggerate everything. But if you have a system, you do not need to be controlled by that noise. You can look at the same day and see what most people miss. You can see that Meta's issue is not revenue, it is spending discipline. You can see that Amazon's strength is not just e-commerce, it is AWS acceleration and advertising growth. You can see that Google's CapEx is easier to justify because cloud revenue is exploding. You can see that Microsoft remains strong but does not have the same acceleration surprise. You can see that Nvidia, AMD, and Micron benefit from the spending decisions of all the giants. You can see that Cheesecake Factory is a very different kind of compounding machine. You can see that SoFi's sell-off may say more about market emotion than business deterioration. This is how I want you to think, not as a trader reacting to candles, not as a fan cheering for a stock, not as a frightened participant who runs when prices fall. Think like a business owner, think like a systems thinker, think in probabilities, think in time frames, think in downside first, then upside. Think about how each piece connects to the next, because the market is not one thing. It is a set of machines. Capital flows from one machine to another. AI spending flows from mega-cap platforms to chip suppliers. Consumer spending flows through restaurants. Deposits and financial products flow through digital banks. Advertising flows through platforms. Cloud workloads flow through infrastructure providers. The investor's job is to understand where the flows are going and whether the price already reflects it. That is all when you reduce investing to that level of clarity. It becomes less emotional, still uncertain, but less emotional. You will never know the future perfectly. You will never avoid all drawdowns. You will never buy every bottom or sell every top. But you can build a framework that keeps you from making the biggest mistakes. You can avoid confusing a tax benefit with true operating improvement. You can avoid confusing revenue growth with healthy scaling. You can avoid confusing capital spending with value creation. You can avoid confusing a one-day stock decline with business failure. You can avoid confusing a popular narrative with a high probability investment. That is how serious investing is done. And that is why a day like this is valuable. It reveals who is executing. It reveals who is spending. It reveals who is receiving the spending. It reveals who is being punished for uncertainty. It reveals who may be underestimated. So stay focused on the long term, but do not use long term as an excuse to ignore the numbers. The long term is built from the numbers reported quarter after quarter. If the numbers improve, the thesis gets stronger. If the numbers weaken, the thesis must be questioned. If management becomes undisciplined, risk rises. If management produces operating leverage, value compounds. That is the principle. The market will always have busy days, but the investor who understands the system can remain calm in the middle of them. That is where the advantage is. Not in knowing exactly what happens tomorrow, not in guessing whether a stock is up or down after hours. The advantage is in understanding the forces underneath the movement, being patient enough to let them play out, and disciplined enough not to bet so much on any one idea that a single mistake can destroy you. That is how you survive. And in markets, survival comes first. Then compounding can do its work.